How does productivity growth affect structural inflation insights? Have you ever wondered how the growth of productivity can influence inflation in our economy? Let's break this down in a straightforward way. Productivity growth plays a significant role in shaping structural inflation, which is the kind of inflation that stems from underlying economic factors. These factors include differences in productivity across various sectors, conditions in the labor market, and the prices of goods that can be traded internationally versus those that cannot. When productivity increases, businesses can produce more goods and services using the same or fewer resources. This efficiency usually leads to lower costs for companies. As a result, when productivity rises, inflationary pressures often decrease. Companies can keep prices stable or even lower them, which helps to keep inflation in check. Now, let's look at how this works across different sectors. If productivity grows faster in the sector that produces goods for trade, wages in both tradable and non-tradable sectors tend to increase. However, prices for tradable goods are often influenced by global market prices. This means they do not rise as much, leading to higher price increases in the non-tradable sector, which includes services and goods produced locally. This can contribute to overall inflation. On the flip side, if productivity grows more rapidly in the non-tradable sector, it can actually help to lower inflation. This is because it reduces cost pressures in that area. When there are large disparities in productivity growth rates between tradable and non-tradable sectors, structural inflation can increase. Wages may rise across the economy, but prices in the tradable sector remain stable, which can push up prices in the non-tradable sector. Wage dynamics also play a role in this equation. If wages grow faster than productivity, it can create upward pressure on prices, contributing to inflation. However, if wage growth aligns with productivity gains, inflationary pressures can be kept under control. It is also important to note that the way productivity gains are distributed matters. If companies choose to keep the benefits of productivity improvements as higher profits instead of passing those savings onto consumers, the inflation-reducing effects may be weakened. For policymakers, understanding these sectoral productivity trends is essential for grasping inflation dynamics. Recognizing that productivity improvements can have different impacts on inflation based on whether goods are tradable or not is key. In essence, while productivity growth generally helps to restrain inflation by lowering costs, its effect on structural inflation is influenced by how productivity varies across sectors and how wage growth responds to these changes. Structural inflation can persist when these factors lead to ongoing price increases, especially in sectors that do not engage in international trade, despite overall productivity improvements.